Hey, good morning, everyone. My name is Drake Lovett. I'm one of the annuity sales directors here at IMES. I want to take the time to thank you all for joining us today. In today's webinar, we are going to be hearing from the Index Standard founder, Lawrence Black. Additionally, I have some important information to share about who we are here at IMES and a quick highlight of why our agents love working with our team. The most important thing you're going to hear me say is in the top right-hand corner of the slide, and that is our phone number, 800-255-5055. We strive to answer your call with times with 2 rings or less. So always feel free to give us a shout if you guys ever have any questions in regards to this webinar or in regards to any of the solutions and strategies that we offer. First thing we're going to be talking about today is our new producers builders bonus. Those of you who are new here at IMES, these are bonuses are available based on your production level in your first 180 days of contracting with us. We have great levels that you can qualify at, and as you can see inside of each level are some great options for you. We've got incredible business building tools, personal perks for you, and even cash rewards available. If you'd like to know where you stand toward your new producer builder, or if you would like to have a conversation about how to achieve the next level, please give us a call or talk to your sales director that you're currently working with. Moving on to the business builders programs, we're going to go over our referred producers program. I can see a couple of our advisors on with us that have taken advantage of this program. Our business on the wholesale side of the industry is similar to yours in the field, and that one of the best leads we could ever obtain is referral from one of our valued producers. This is why we want to make it worth your while to refer a producer to us. That being said, when you refer a producer to us and they get contracted with you, we will cut a $50 thank you check. Now, where the real money comes from is as a referral rights business, you will receive an override on that business. Our ownership team, Steve Murray, Charles Hearing, and Curtis Hawk, sign checks for thousands of dollars every quarter. With that being said, if you can think of anyone that could benefit from doing business with our team, please type their information in the question box. Or you can email me at drake@imesinc.com. That information below is our marketing reimbursement program, which is our most popular program that we offer. For each $100,000 in fixed index annuity premium, you get $100 in marketing reimbursement to your account. Why this is so popular and lucrative for our advisors is we truly do consider this to be your money, and we do not cap your account, mandate where you spend the funds, or tell you to have to cash that account. It is truly your marketing reimbursement. We don't tell you what vendors to use, or we do, however, recommend vendors that we partner with and leverage reduced rates and preferred services. We also have a creative team to create marketing strategies and provide in-house services. If you would like to know how much is in your marketing reimbursement account or have a conversation about how to utilize it, give your sales director a call at our office. We'd love to speak with you in more detail. So going over our back office support, this is another way we add value to your business. This is the core of IMES and how Charles Hearing founded us 36 years ago. We want to help the independent advisor work smarter, not harder. We're going to do that with great business building tools and resources. Of course, advanced case design assistance, life and annuity quotes. With that, we make a 24-hour turnaround guarantee to you. We're going to get you those illustrations that you request within 24 hours of your request. I'm going to be honest with you, in all of the reality, you're going to get it much quicker, usually within an hour. Submission to commission support is handled by our new business teams. Amber Williams heads up the annuity side, and Cindy Fry heads up the left side. They have a fantastic team who works tirelessly to help you get commissioned quicker. We will scrub your applications, submit them on your behalf, do all the administrative tracking, and get your updates on the cases needed. We do this to ensure you get commission as quickly as possible. This is a service that we provide to our valued producers and how we help you grow your business by keeping you in the front of the clients, or our team handles the back office support for you. Moving on to Firelight and electronic apps. This is a single sign onto at IMSinc.com. Technology is where the industry is going, and Firelight is a top resource site streamlining the application process. Most of our carriers are on our e-app platform, so you can go to one site and submit business. It is COVID friendly, and some carriers are going to e-app only for some of their product lines, and will also offer extra comp for utilizing the e-app platform. Make sure you ask your sales director before you submit a paper app if you can earn more by doing e-app. Going on, utilizing our Firelight platform accelerates the application process substantially. The e-app platform helps you submit business in good order the first time. This also reduces the processing time of your business and gets you paid quicker. And as I mentioned previously, this is a single sign-in to IMSinc.com, as we have integrated our business with Firelight so you can have the most efficient and effective way to submit business. We do have a full in-house creative team as well. We can help you help your practice, and a lot of times are turnkey and available for you. We can simply impose your contact information and your business logos onto it. Speaking of logos, agency solutions are something that we are very good at, and something that if you haven't created a full customized brand for you and your agency, we can help. This is going to assist you with name recognition, which grows your natural market organically. We can get you a logo designed and imposed on your business cards, brochures, and stationaries. Lastly, what everyone is currently looking for, digital marketing solutions. We can help you with websites, social media marketing, email marketing. Most everything on here will happily assist you with. The internet and social media sites are where the overwhelming majority of prospects go for information. Making sure you are accessible and represented in those marketing lanes is beneficial to growing your business. Feel free to reach out to me or one of our sales directors when this webinar concludes to talk more about how you can access IAMS Creative, and we can certainly get the ball rolling for you. Our website here is a great tool for our producers to use, and another reason to work with IAMS. Once you are contracted, you will have full access to everything you see on this slide. So much more information at IMSinc.com. Of course, if you haven't registered for the website, it is a very simple to do. Once we're done with this call, go ahead and create an account. We'd love to see you on there. A lot of great tools available to you: illustration tools, online forums, product grids, product news, industry updates are out there for you as well. All right, I'm going to launch my first poll question of the day. Simply asking, would you like more information on IAMS Wealth Management? If you click yes, you'll receive an automated email and receive a call from Duncan Smith to speak with you about who they are and what we can do for you. We founded IAMS Wealth 4 years ago, and what we've done is grow the division on IAMS very organically. We've helped advisors become IARs and pass their Series 65s at very successful clips. Once we have you registered, we will bring great value to your practice with an incredibly competitive fee structure for both you and your clientele. We have a great technology and great investment platform. This has been a major growth sector for our business, and assets under management could be a major growth sector for your business as well. Give it a few more seconds here before we move on. Okay. All right, moving on. It's official. We're going to be hosting a Life Annuity Academy this September. the 14th through the 16th. It'll be held in Omaha, Nebraska, which is where our home office is located. These 2-day trainings are an excellent opportunity for our agents who are looking for new ways to grow their business. These events are an excellent opportunity for anyone active in the life and annuity markets. All expense paid academias give you an opportunity to learn from our top producers that will go over the marketing strategies they have used to get from the bottom to the top. It also gives you a chance to speak with your peers in the industry from all over the country. I highly recommend that you do get registered for these events. Moving on, one of the benefits of working with us here at IAMS is trips such as this who are currently in qualification period for a great trip to Park City, Utah. So a lot of ways to earn extra incentives there. We share a lot of great information on our social media platform as well. Go out there and like us on Facebook and connect with us on LinkedIn. Okay, and with that, I am going to introduce our co-host with the Index Standard, Lawrence Black. Lawrence, feel free to take over and let me know as you would like to move through the slides.
Thank you, Drake, and good morning, everyone. Let's move to the next slide, please, Drake. So my name is Lawrence Black, and I'm the founder of the Index Standard. I founded the Index Standard about 3 years ago now, and you can think about us as a mini Morningstar. I've spent most of my career designing and developing indices, and my partner at the Index Standard, Jay Watson, has also spent a number of years at Barclays, where he ran groups that designed and developed indices. So what we do is a little bit like Morningstar, we produce ratings for each of these indices used in the insurance space, and we also provide some forecasts. So what I'm going to do today is really two things. I'm going to give you an overview of what's happening in the insurance space in terms of the indices being used, the sort of types and the numbers and some of the trends we see. And then secondly, I'm going to review some of the performances, some of the top indices by performance, and also have a look at some of our forecasts to give you some insights as to what's going on in the market. So if we can move to the next slide, please, Drake. So the first thing, what is the trends that we've seen in the first 6 months? So I'd say the main trend is the following. We've seen innovation continue. So we've seen a number of long-short indices being launched. So what we mean by this is some of these new indices, especially this year, they have the ability to go short. That means they can short a particular index or some stocks in the expectation of prices going down. So, well, why have we seen this trend? I think we all know that markets are pretty high. They've been bonds have been, exceptionally expensive as well. We've had 40 years of a bond bull market. So I think the index designers, in response to sort of potentially overvalued markets, launched these indices with the ability to short. And, it's been a pretty good time given what we've seen markets do. Just to sort of unpack where we are today. So, some of you on the call, I'm sure will remember, it was, let's say 15, 20 years ago, it was just really all about the S&P, potentially the NASDAQ, and maybe an MSCI Europe or MSCI emerging markets. And we've seen some risk control indices come in that aim to sort of cushion, stabilize. So a lot of indices that use mean variance optimization. We've seen sort of prop signals that get in and out. We've seen kind of innovative stuff such as artificial intelligence, and we've seen intraday vol control. And then today, as I said, the sort of most recent trend we see at the Index Standard is these long short indices. Just to let you know, we've seen 11 indices being launched year to date. This contrasts with about 22 indices we saw in 2021, and we saw about 24 launched in 2020. So, the innovation is continuing. Drake, let's move to the next slide, please. So here's an overview of what's going on in the index world. We track every single index that's being launched, and we also track all the ones that were available but no longer being used. So we see a universe of about 180 indices. So it really has got pretty crowded, and there's over sort of 35 index providers. Now this is quite a busy slide, so I'm going to break down this each of these key graphs in one. So if we'll move to the next slide, please, Drake. So the first thing is, who is launching all these new indices? So by far and away, we see S&P Dow Jones indices with the most. They've got about 36 in use in the market. We all know and love the S&P 500, but they've obviously come up with other ones such as the risk control complex, well known for the Mark V. Then we see Barclays, Goldman, JP Morgan, and Morgan Stanley. A number of the big investment banks are all pretty well entrenched with a number of indices. What I would also say is we're seeing more and more asset managers come into the space. So we've already seen big names like Fidelity, who are our players. We've seen PIMCO, we've seen BlackRock with a number of indices. But this year we've also seen Invesco have launched an index for the first time. Another smaller asset management company called Advantis has launched one as well. And we're aware that another sort of investment bank that's Asian-based will be launching an index into the FIA space. So it's actually becoming a very popular place. And as I said, more than 36 providers. Next slide, please. So which carriers are using this? So, in this graph, we exclude the S&P 500, the Russell, MSCI emerging markets, etc., as those are pretty much used across the board. But in terms of sort of custom risk control indices, we see Athene are the biggest user with 15, closely followed by Nationwide, American General, Lincoln, North American, Salmon, Security Benefit, and Allianz are the next biggest users. So pretty nicely spread across the carriers. Next slide, please, Drake. So what are the underlyings of these indices? So that's something that we want to track and understand. So by far and away, we see the most are multi-asset based. So that means they might include some equities, bonds, commodities, or gold. And then the next biggest is equity, bonds, cash, and then just equity and cash. What I would say is in 2021, we saw a lot of equity bonds indices being launched. That was the kind of popular trend. And then as markets sort of got a little potentially expensive, I'd say the index providers already switched to multi-asset. And that's what we've seen today, a lot of multi-asset indices. Now, multi-asset indices give you the best opportunity for diversification. So I think that's what the providers have said. Well, markets are a bit toppish. Let's give people multi-asset indices with lots of potential drivers of performance. And then just before I move on to some of the performance slides, we see 5% target vol has been historically the most popular. I'd say, recently in the last sort of month or two, we've seen a couple indices with 8%, 6% vol targets. So as rates have increased, we're seeing some of these vol target levels increase. All right, let's move to the next slide with some performance, please, Drake. Thanks. So here are some of the performance as of the end of June, sort of a half-year review. So let's look what happened. I think we all know the story that the S&P has struggled this year, and as of the end of the 6 months, it was down 20%. So how did the risk control indices do? Well, you can see they've actually done pretty well. Now I'm going to focus on the yellow bars. That's the year-to-date return. So I think a reasonably good sort of benchmark for a pretty simple vanilla risk control index is the S&P 500 7% risk control index. So you can see that's just down 7%. So a lot less than the S&P 500 at 20. Then you've got the multi-asset and equity cash that have actually displayed pretty strong performance at down just around about 5-6%. And then you've got equity bonds down at about sort of -8. So let's dig into this a little. So let me make two observations. Firstly, some of you may be thinking, well, I know I've got a 0 on my FIA. So what do I care if what's the difference between down 5.7 or down 20? Well, the key thing is it's a lot quicker and easier to recover from a drawdown of 5% versus down 20%. And if you're down 20%, you need markets to rise quite substantially to get back to 0. So if you're down just 5, it's easier to kind of get a positive credit for your clients. And you always want to be getting a positive credit. So kind of observation number 1. Now, I think the equity, cash, and multi-asset, you can see the yellow bars down minus 5.7. That's a strong performance. Now, equity bonds is a little disappointing, down at 8.6. Still much better than the S&P, but what really happened here? So I think the story there is really you saw the S&P fall and the Barclays Ag, which is a good proxy for any fixed income investment, was down about sort of 7-8% as well. So, that's really hurt the equity bonds where their two main asset classes both fell. And they normally rely on, these two asset classes to yin and yang, move in opposite directions. What's called negative correlation, but we didn't see any of that this year. They've both gone down. It's been very unusual. So that kind of explains some of that performance. Now let's move to the next slide, please, Drake. Now, one thing we wanted to draw out is, as I said, we've seen a number of indices that are risk controlled, but they have the ability to short. And we wanted to check how have these actually done, because this has really been sort of in the environment where they're supposed to perform, with markets going down sort of circa 20% that we saw in the S&P. So you can see ringed in purple, they've actually done pretty well. So if you took the ability to short, you were actually only down 5.4% versus the rest of the sort of risk control universe that was down about 8.8%. And again, I'm focusing on the year-to-date yellow bars. So we're quite pleased to see that the indices that have the ability to short seem to have delivered on some of their performance promises. Next slide, please. So now I'm going to focus on what we call equity QIS. So that's for quantitative indices and strategies. Now, these indices are actually all used in RILAs. So as you know, RILAs have buffers and caps and floors. So they tend to use beta indices such as the S&P 500. And then what we've seen is a number of the providers have launched sort of beta indices to be used exclusively in RILAs. Sort of good example is the HSBC have got a couple indices. We see some risk control indices as well, but we want to isolate the sort of pure beta and compare them just to the S&P 500, which again is pure beta. So again, focusing on the numbers in yellow, which is the year to date, we can see the equity QIS indices have actually done pretty well, right? They're down 4% less than the S&P 500. So a number of these indices, they have features where they'll either look for example, stocks with high dividends, or they'll have a value orientation where they'll look for stocks with low PEs, or they might look for quality stocks. And you can see that's probably some of the reasons that have driven their outperformance. The S&P is very tech heavy. We've seen some of those names have suffered, whereas sort of stable, undervalued stocks that are producing good earnings and good dividends have performed pretty well, and just down 16 versus the S&P at 20. So that's the really story there. So some of these indices have actually performed pretty well in the RILA format. Moving on to the next slide, please, Drake. So here I want to sort of focus on the risk and return. So when you're looking at these risk control indices and comparing them to the S&P, you can't really compare them on a sort of raw index return. You can't sort of say, well, the S&P was down 20 and a risk control index was down 6%. You've got to look at their sort of engine size, because they have different capabilities. A 5% vol target is sort of, you can think about that as maybe a 300 horsepower engine, and the S&P, it's very volatile. It's got like maybe 1,000 horsepower engine. So how do you equate that? Well, you look at something called the return divided by the volatility. here, what we're showing is this return divided by volatility. And I want to focus on the 3-year numbers, the numbers in blue. So let's look at the S&P on the right-hand side. That's the kind of key index we all follow and we all love. It's got a ratio of about 0.36, so pretty solid. So now I'm going to look at the S&P 500 7% risk control index. You can see it's got a ratio of about 0.49. So that's actually pretty good. It's actually outperformed the S&P, the base S&P, by about a third. So that's really, a lot of us question these risk control indices. How do they perform? But if you look at the data, they actually outperform the S&P in terms of risk-adjusted returns, or you can think about that as a sort of net credit basis. Let's move on and look at some other categories. So I would say the equity, cash, and multi-asset are pretty strong at 0.38 and 0.32 respectively. So, same as the S&P. Equity bonds a little disappointing there. And then, with the ones that have the ability to short at a 0.31 in the middle, pretty solid. What I think is also interesting is on the extreme right, you can see the MSCI Europe, beg your pardon, MSCI EFA, and it's been a little bit disappointing. We know that returns from Europe and international markets have not been as strong. They've had a sort of series of struggles from the European debt crisis through to the Ukraine war, so returns have been very low there. Let's move on to the next slide, please, Drake. So what are the best performing indices? So what we see is here are the best performing indices from January to June. And it's kind of no surprise that it's the commodity index that leads the way. We all know that energy's really experienced a really upward trend given the war in Ukraine. And then let's take a look at a couple other ones. I'm just going to pick out a couple. Number 4, the Wisdom Tree Siegel Strategic Value Index, up almost 7%. That one has the ability to short. So, that's why it performed very well. 2 Prism indices, been around for a couple of years. S&P, pretty nice. Then looking at 9, 10, 11, and 12, those are all sort of equity-based indices that select stocks with high dividends, stocks with solid cash flow, and you can see that they've performed pretty well because they sort of have a bit of a defensive outlook. And then 13, 14, 15, all multi-asset indices benefited from some solid performance from rotating through asset classes. Now, Drake, if we can move to the next slide, what we show here is the best indices over a 3-year period. They must be live. And we're looking at the risk divided by the volatility. And what you see is that S&P Prism is the best at about 1.4. UBS Market Pioneers, which combines equities and commodities, done very well. We've talked about the Wisdom Tree, the Bloomberg Commodity Excess Return Index. Obviously, we kind of know what's driven that. And you see a couple of multi-asset indices. The Barclays Armor Index, pretty old one, but the PIMCO Tactical Balanced, and these number 8, the City Flexible one, are again solid performance. Now, what's kind of interesting about this that struck me on this list is what's missing. The S&P 500, right? Where is it? It's kind of, just to let you know, it would come in at about numbers sort of in the top 20. But I all think, in our minds, we all think, oh, the S&P's had this amazing performance. And it has done well, but what you really have to think about is, what's the post-credit experience? So let me give you an example. Let's say the S&P returned 10%, and you probably had an average of 30% participation over the last year. I know rates have moved up, but let's just average that out over the last year. That means you're going to get a net credit of about 3%, right? 10 times 0.3, you're going to get 3%. And then consider a risk control index. If it returned 5% on a raw basis, half the S&P, but let's say the participation rate was about 120, you'd get a net credit of 6. So that net credit of 6 compares to the S&P 500 of 3%. So that's the example you want to sort of think about, right? Some of these risk control indices with these high par rates you see, they don't actually need that much of a raw index return to actually outperform the S&P. So kind of interesting when you think about it. We all think the S&P has performed incredibly well, which it has, but if you look at the data, some of these risk control indices have performed pretty well too. Moving on to the next slide, please, Drake. Thanks. So, you know, drawdowns hurt us in investing. So we wanted to look at what's the maximum drawdown over the last 3 years, and it kind of actually turns out it's the COVID period where we saw the S&P down 33.9% on the right-hand side. And then you can see some of the asset classes for the multi-asset risk control index group, or the equity cash, equity bonds, all pretty solid, you know, in the down 11, 10%. And then as a sort of individual benchmark, the S&P 500 7% risk control index on the far left, down 9%. So they do cushion and smooth returns. Next slide, please. So one thing we also do at the Index Standard, we look at expected future returns. So we go to about 35 asset managers and we average all their expected forecasts for the 10-year forecast for the S&P. And then we apply all their expected forecasts to these individual indices. So asset managers have been forecasting, you know, ever since Charles Dow in the late 1800s, and you saw Benjamin Graham do it. We've seen Jack Bogle at Vanguard, who had his S&P 500 forecast model where he looked at PEs and dividends to try and project a long-term return for the S&P 500. So people have been forecasting for decades. So we at the Index Standard, we averaged 35 asset managers. We averaged their 10-year forecasts. So here you can see their raw index forecast for the S&P. 35 of the smartest asset managers are forecasting annualized returns for the S&P at just 4%. So that's pretty low. You can see that's come down from the line in blue of over 10% annualized returns for the S&P over the last 10 years. So a way to think about that is the illustration, right? The illustration, the carriers or the insurance software is showing you is at 10.7, but actually this wisdom of Wall Street expect the S&P to return about 4%. So that is quite substantially lower. Now what we do at the Index Standard, we take about 15 forecasts across the S&P, Russell 2000, EFA, international markets, commodities, gold, and all the fixed income complex. And we apply these forecasts to the risk control indices to kind of get another way to think about what could your expected returns might be. And we actually see that the whole risk control complex looks like it's around about the same as the S&P, with around about 4%. You can see the lines in yellow. Equity bonds at 4.1, equity cash at 4.1, and multi-asset at 4.3. So round about the same as the S&P. But then if we roll forward to the next slide, as I mentioned earlier, you know, it's really about what's the net credit. So here we take those same forecasts and we divide them by the volatility to get a sort of a risk-adjusted return, or you can think about this as the sort of post-participation experience. So you can see with the expected higher par rates on these risk control indices, you can actually expect much higher sort of net credit returns in the S&P. Because the S&P is so volatile, especially right now, the volatility is pretty high with markets yinging and yanging and zigging and zagging all over the show. You know, the par rates in the S&P the last year have been, let's say, 30%. We've seen them tick up in the last couple of months as rates have risen to about, you know, 50% maybe par rates. But we've seen the par rates on these risk control indices where some of them are now above the 200%. So we do expect that you may actually get some solid credits from some of these risk control indices. So we just encourage people to be diversified there. And then moving on to the next slide, please, Drake. Now, what we also did was we looked at all the indices that have been live for 2 years. We wanted to pull out what are our forecasts, what do we forecast for each of these indices. So you can see the top one is the Morgan Stanley Global Opportunities Index. It's multi-asset, pretty diversified. It uses a solid mechanism, uses optimizes, uses a mean variance allocation tool, and we expect it might return around about 5. Then going down, the SG Global Balanced also 5. Goldman Sachs Voyager at 6, JP Morgan Mosaic at 5. Now we've ordered this by the expected risk return. But now where does the S&P come in? So the S&P, you can see the live index forecast as of August, and I updated these numbers, is 4.3. And so there's a number of other indices that are ahead of it. And we think about this as the post-credit experience with these higher par rates does make sense to be diversified. We can help you generate better returns for your clients at the index standard. That's what we do. So I'm going to move to the next slide now, please, Drake. So that ends the overview of the indices. As I said, we've tracked about 180 indices. We track the individual performance. We forecast them. We're really interested to understand what's going on in the market, present you, the advisor, with more insights. If anything's piqued your interest, you can contact Drake or you can contact us. If you'd like a free report, a forecast, or an index rating, just email us. You can see my email address is lawrence.black@theindex-standard, or even easier to remember, info@theindex-standard. Please email us if you want to see the slides or any forecasts or anything piqued your interest. I want to thank you for your time today. It's been great to take this opportunity to present to you, and I'm going to hand it back to Drake, who will close us off.
Hey, thanks, Lawrence. That was very informative and definitely some great information there for folks trying to navigate the indices that are out there and many of these fixed index annuity solutions to help clients maximize their earning potential. So much like he said, feel free to reach out to either one of us. I'll be touching base with the attendees on this moving forward over the next couple of days. So expect an email from myself or a call. And of course, if you guys do have any questions, feel free to, again, email myself and we can definitely get those answered. The last thing I wanted to do was take one more poll. And if you would like more information on the topics we discussed today, go ahead and vote yes or no. If you vote yes, I'll make sure you guys get that information by this afternoon. All right, awesome. Well, very cool, everybody. Again, we appreciate you guys taking the time. Lawrence, thank you for coming on here with us and sharing the information and what exactly you guys do over there at the Index Standard. Hope you all have a great rest of your day, a great week, and feel free to reach out to either one of us at any time.
Thank you, everyone. Thank you, Drake.